Walking to my meeting this morning, I found myself reflecting on everything that's unfolding globally at the moment, with escalating tensions involving Iran and growing uncertainty across global markets. It's important to acknowledge that behind every headlines are real people and societies that have lived with uncertainty for many years. And moments like this are felt deeply far beyond financial markets. Periods like this naturally create concern, and over the past few days I've already had clients asking what events like this could mean for the economy and, closer to home, for the property market. And the reality is that property doesn't respond directly to conflicts or headlines, it responds to economics. And when geopolitical tensions raise concerns around global energy supply, oil prices tend to rise. That can place renewed pressure on inflation, and then that influences how long interest rates may remain higher. And ultimately, interest rates and confidence are what shape activity within property markets. So we've seen similar dynamics before during periods such as the Gulf War in the early 1990s, and more recently following the invasion of Ukraine in 2022. And rising energy prices created short-term uncertainty across global markets. Transactions slowed, sentiment became more cautious, but over time, capital tended to move towards stable and transparent cities rather than away from them. And London has historically been one of those cities, not because it's immune to global events, but because during uncertainty, investors often prioritise stability, rule of law, and long-term security. So rather than reacting to headlines, the more pragmatic approach is to watch the economic indicators that follow. And prime property markets tend to move slowly but decisively once monetary conditions become clearer. And moments like this are a reminder that property is ultimately a long-term asset class navigating short-term uncertainty.